Let's start this question set with an easy theory question to get warmed up. And we have statements to evaluate. Which of the above does the manager of an investment center control? Well, that manager will be responsible for controlling the costs, generating the revenue, and deciding on whether or not to invest in non-current assets. Should we invest in a new delivery truck, a new fleet of delivery trucks to increase our market share, for example? So, generation of revenues. Yes. Investment in non-current assets. Absolutely. Investment in working capital. Yes. Apportioned head office costs. No. This is the head office recharge. The headquarters will cover its cost by sending an invoice to the investment center, and usually the manager of the investment center does not have control about that head office recharge. Okay, so the best answer is 1, 2, and 3. Answer A. Here we have a calculation type of question. There's a lot to unpack here. Let's read the requirement first, see what information we need before we start reading. If residual income is used as the basis for the decision, which divisions would invest in their projects? Okay, so before we do anything, let us recall residual income. Residual income, guys, is the absolute measure where we take our operating profit from which we subtract quote-unquote imputed interest, or the minimum required return in dollars. So we can now just get set up for that. We've got two divisions, we've got A, we've got B. We need the operating profit, then we need the cost of capital, I'll abbreviate that CC, multiplied by the investment. Cost of capital, that is the required return of the investors. So that would then give us the minimum required return. The difference between those two figures would be residual income. Now, do we have operating profit? Let's look. We've got capital required. Okay, so that's going to be the investment there. We've got the sales. We don't have the operating profit directly, but we get the margin. So right away, get out your calculator and we can get that. 30% of 14.4 and 24% of 18.8. The first one is 4.32. Second one is 2.11. Do we have cost of capital? Yes, they make it easy for us, 10%. Okay, so 10% of the capital required, 13.26, so that would be 10% of that, 3.26. That is the minimum required return in dollars that the investors would want, and then 10%, 2.22. Okay, there we go. Now the answer is jumping out at us. This number will be positive, won't it? This number will be negative. Investors will be happy to have returns higher than their minimum required return. Over here, we don't hit the threshold. So we like division A only as the answer to this question. This next question is a tricky numerical residual income question. Let's read this first. Residual income, annual. Let's set up a template before we do anything. So we need the operating profit, put a P for the operating profit. We need the cost of capital multiplied by the investment. That's the minimum required return in dollars. Okay? And the difference would be residual income. Let's read. Division is considering investing in capital costing $2.7 million. The useful economic life of the equipment is 50 years. The only reason they would tell us that is for some depreciation calculation. No resale at the end. The forecast return on the initial investment is 15% before the depreciation. So we need to subtract that depreciation to get the profit. Division's cost of capital is 7. So this line looks like the easiest one to start with. It's simply going to be 0.07 multiplied by 2700, putting everything in thousands, and we get a 189. We're going to make that negative. Now my profit is going to be 15% per year, 0.15 multiplied by 2700 minus the depreciation, which is 1/50th of that, right? So let's get the depreciation charge quickly. 1/50 times 2700, $54 per year. So we'll subtract 54 from that. Let's put this in brackets. And the profit then would be 351, okay, per year. So the residual income is 162. Answer, everybody, is C. Let's read the requirement first. What is the expected return on investment of the division for the year based on average capital employed? This is a difficult looking question. There's a lot to unpack here. We see the information embedded into the sentences of this paragraph. So this is an example of a tricky question. Let's start by looking at the definition of ROI, just to get started. So return on investment will be equal to some operating profit, which I can abbreviate as P, over some average capital employed. Let me share with you now a very nice trick that we can use whenever we're messing around with capital employed. And this is not in the answer in the model solution, so check this out. Just remember this: non-current assets plus current assets are equal to my company's equity plus the non-current liabilities plus the current liabilities, the accounting equation. Now, we can tweak this equation a bit. We could say that the NCA, the non-current assets, plus the current assets minus the current liabilities, we take it off of here, will be equal to the equity we have plus the long-term debt, equity plus debt. Now we can rename some of this. Non-current assets plus the investment in our working capital is equal to my capital employed, right? That's my investment in the company, everything that I took out of my pocket as a shareholder and what I borrowed from the bank, capital employed. Okay, now with that, let's look around in the question and see what we find. At the start of the year, the division has non-current assets of $4 million. Makes no additions or disposals in the year. We get a depreciation rate. Working capital is $0.5 million at the start of the year. So look at this. We can now do the opening capital employed. You remember, if they tell us that the non-current assets are $4 million and the working capital is 0.5, then that has to be 4.5. So my opening capital employed is 4.5. Now, do we have information about the closing capital employed? Depreciation is 10% per year. Now we can use that. So that means the value of our assets will drop 10%, and working capital is expected to increase by 20%. So now the closing capital employed, that's going to be equal to what? They said the 4 is going to drop 10%, so that's going to be 3.6. The 0.5 is going to go up 20%, so that's going to turn into a 0.6. 3.6 plus 0.6 is 4.2. So my closing capital employed is 4.2. Add those figures together, divide by 2. 8.7 divided by 2 is 4.35. That is my average capital employed. Now all I need is my operating profit, and I can get the answer. Operating profit, the budgeted profit of the division after depreciation, okay, is 1.2. That's the only information we have. We have to assume it's the operating profit. So now we can put a 1.2 there. And that is the answer. Friends, 27.59. Answer, everyone, is A. This next question, another tricky math puzzle, return on investment. Okay, similar to the last one. Another tricky question, a lot to unpack from the scenario above. So first thing to do, read the requirement and let's put the formula down. Return on investment. Okay, so ROI is equal to some operating profit over some investment, some capital employed. Let's read. At the end of the year, an investment center has net assets of $1 million and annual operating profits of $190,000. However, the bookkeeper forgot about a couple of things. This is going to make an adjustment to both the operating profit and the net assets. A machine with a net book value was sold at the start of the year for $50,000 and replaced with a machine costing $250,000. Both the purchase and sale are cash transactions. That's nice. So there's no accruals happening here. No depreciation is charged in the year of purchase or disposal, and it's based on closing. The ROI is based on the closing net assets. Okay, so let's start with our opening profit and the unadjusted capital employed. So we have a P, we have a CE, and 190, 123. They didn't give us an easy one, 19%. We could have just eliminated, couldn't we? But no, they didn't give us an easy item to eliminate from the list. Well, how much profit did we make on the sale? Okay, the net book value is 40. We sold it for 50, so we made an extra $10. Okay, so that's the profit on the sale of the asset that we forgot to book. Okay, and then we have the net book value of the asset, so that's going to be minus 40. Okay, plus the cash that we received for that, 50. And then the other new asset, the 250, we paid cash for that. So that's increased the non-current assets, decreased the cash. So then there's no change to my assets there if we're using cash. Okay, so now we get the difference. That's going to be 200 over 1010. And the answer then is 19.8%. Answer, guys, is B. First glance, this is a tricky looking question. I see the word transfer price jumping out at me here. Many of you don't like transfer pricing, but let's go for this question together here. Read this part first. If the division B accepts some offer, what will be the impact on profits for the year for the group as a whole? Okay, there's a lot to look at here, a lot to unpack. Let's go through it. Oxco has two divisions, A and B. Division A makes a component for air conditioning units, which it can only sell to Division B. There's no other outlet for the sales. So we can quickly sketch the group. We've got A, got B. A sells to B. B then must be selling out of the group. And the marginal cost per unit, 100. That is the variable cost to make an air conditioning component. The transfer price is 165. The total units that we do are 2200. Now we have some fixed costs for A, 10K, right? So those are the fixed costs. Now, the division is looking at a new supplier who has emerged. This supplier is going to start selling us the same component for 140. Now, we're looking at the combination of transfer pricing and essentially make or buy. So the transfer price, not really relevant right now. It's higher than the external price, but if there's no external demand for my units, then the minimum transfer price would be the variable cost. So with no other information at this point, it would be better to use the internal variable cost of 100 rather than the external. However, we're going to shut the division if we do this, so we're also going to save the full 10,000. So now it becomes make or buy, essentially. So let's evaluate the decision. If we make the units in the group, we will incur variable cost and fixed cost. 2,200 times 100 will be 220,000. We'll incur fixed costs of 10,000. So the make cost to the group is 230,123, 230,000. Now, if we decide to shut down the division and buy from the new supplier, it'll be 2,200 multiplied by the 140. And that comes to 308,123. Okay, so if we decide to shut down the division and buy from the external supplier, that is 78K more expensive. Okay, so that would decrease our profits $78,000. Answer, guys, is option B.